Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Assurant Inc. Annual Report. Assurant Inc. offers a wide range of protection services across various segments. The company's global lifestyle segment provides mobile device solutions, extended service contracts for consumer electronics and appliances, financial services, vehicle protection, commercial equipment services, and other related services. In addition to these offerings, the global housing segment provides lender-placed homeowners insurance, manufactured housing insurance, flood insurance, renters insurance, voluntary manufactured housing insurance, condominium insurance, and homeowners insurance products. These services cater to various needs of individuals and businesses across North America, Latin America, Europe, and the Asia-Pacific regions. Overall, Assurant's diverse portfolio of protection services makes it a comprehensive provider in the industry, serving multiple markets with its extensive range of offerings. Assurant Inc.'s stock price has experienced a slight increase over the past year, with some sources indicating an increase of approximately 9.92% to 10.44%. A significant news event that likely contributed to this positive trend was the announcement of its fourth quarter and full year 2025 financial results on February 10, 2026. The financial results exceeded analyst estimates, showcasing a 7.9% year-on-year revenue growth, reaching $3.35 billion, and a non-GAAP profit of $5.61 per share that beat analysts' consensus by 1.9%. This marked the company's ninth consecutive year of profitable growth, demonstrating its consistent financial performance. While the immediate stock reaction on February 11, 2026, showed a decrease of 8.65%, the strong financial results and positive outlook presented in the earnings report are likely to contribute to a long-term appreciation of the company's stock price. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, investment portfolio performance plays a significant role, particularly through fixed maturity securities. The company's commercial mortgage loans also contribute to revenue growth, as do improvements in credit quality indicators such as loan-to-value and debt service coverage ratios. Conversely, revenue decline drivers include decreases in investment portfolio value, deterioration in credit quality indicators, and economic downturns. These factors can increase the risk of default and negatively impact revenue. The segment revenue growth or decline varies across different insurance products, with life insurance in force premiums and accident and health insurance premiums showing increases, while property and liability insurance premiums decreased. The overall trend suggests that total revenue has decreased, as indicated by a decrease in net cash provided by operating activities from $447.9 million in 2023 to $396.2 million in 2024. This decline is likely driven by the factors mentioned above, including decreases in investment portfolio value and deterioration in credit quality indicators. The company's financial performance indicates a consistent generation of positive operating cash flow. According to various summaries, net cash provided by operating activities has been steadily increasing over the years. In 2025, the company generated $1.83 billion in operating cash flow, surpassing the $1.33 billion recorded in 2024. This trend is also evident in previous years, with a notable increase from $396 million in 2024 to $447 million in 2023. The consistent generation of positive operating cash flow suggests that the company's operations are profitable and generating sufficient funds to support its growth. The analysis of the company's debt level and interest expenses reveals some notable trends. The company's debt level has increased significantly from 2023 to 2024, primarily due to the issuance of new debt and repayment of existing debt. This increase in debt may have led to a change in interest expenses, although explicit information on this is not provided. The interest expense figures for 2022, 2023, and 2024 show relatively stable numbers, with only a minor increase from $107 million to $109.7 million between 2023 and 2024. However, the conclusion drawn from the analysis suggests that the company's total debt or interest expenses have likely changed significantly due to changes in debt levels and interest rates. While there is no explicit information on significant changes in interest expenses, it can be inferred that the increase in debt has had some impact on the company's financials. The exact magnitude of this change remains unclear, but it is evident that the company's debt level has increased significantly over the past year. The financial performance of various segments and regions has been analyzed based on extracted summaries. The global housing segment stood out as a top performer, with its adjusted EBITDA increasing significantly from $574.2 million in 2023 to $858.7 million in 2025. In contrast, the global lifestyle segment struggled, experiencing a decline in adjusted EBITDA from $792.3 million in 2023 to $801.3 million in 2025. The corporate and other segment also underperformed, with negative adjusted EBITDA for all 3 years. Other regions such as Europe, Latin America, and Asia Pacific did not have specific performance metrics mentioned, making it difficult to assess their financial performance. However, the fact that North America has a significant presence of employees, 72%, suggests some level of activity or growth in this region. Management's outlook and strategy remain unclear. The annual report of the insurance company provides a comprehensive overview of its financial performance and activities through various sections. However, upon reviewing the extracted summary, it appears that management has not made any explicit statements regarding their outlook or strategy for the company. This lack of clarity is notable, as investors and stakeholders often rely on management's guidance to understand the company's direction and goals. Without a clear statement from management, it can be challenging to discern the company's priorities and objectives. The absence of an explicit statement from management suggests that the company may not have made significant changes or announcements regarding its strategy or outlook in this annual report. However, further review of other sections or additional reports may provide more insight into the company's plans and goals. The company has made several acquisitions and divestitures in recent years. In terms of acquisitions, the company acquired a new renters book in 2025, but specific details about this acquisition are not provided. Additionally, the company acquired new businesses in 2025, although no further information is available. In terms of divestitures, the company has sold or exited several businesses through reinsurance. One notable example is the sale of its long-term care division to John Hancock Life Insurance Company for $472 million. The company has also sold other businesses and operations centers in Miami, Florida, and Florence, South Carolina. The company's divestitures have resulted in significant financial transactions, including the sale of $175 million worth of senior notes due in 2026. These acquisitions and divestitures demonstrate the company's efforts to adapt to changing market conditions and optimize its operations. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors over the past few years. Specifically, in 2024, it paid out $168.4 million, while in 2025, it is expected to pay out a substantial $925.1 million. In addition to dividend payments, the company has also been actively buying back shares from the market. This practice allows the company to reduce its outstanding share count and increase earnings per share for existing shareholders. The company's share buyback activity has been steady over the past few years, with notable amounts being $468.3 million in 2025, $303.7 million in 2024, and $307.4 million in 2023. Overall, the company's commitment to returning value to its shareholders through both dividend payments and share buybacks demonstrates a strong focus on shareholder value creation. There are concerns about inventory buildup or supply chain disruption that could impact our business operations and financial condition. Inventory levels may vary due to differences between actual and forecasted demand, as well as supply chain constraints. Sales of our products and services may decline if we fail to develop and maintain distribution sources. Supply chain disruptions can also affect the value and availability of devices, particularly in light of adverse foreign trade relationships and escalating U.S.-China and China-Taiwan trade tensions. Increasing costs due to supply chain disruptions have been observed in various business segments, including global housing and global automotive. Limited availability of credit, geopolitical events, and supply chain disruptions can also impact our operations. General inflationary pressures and supply chain disruptions have increased the cost of paying claims, while shortages in the labor market have driven up labor costs. The potential for continued supply chain disruptions may further increase these costs. Furthermore, global supply chain disruptions could have a material adverse effect on our results of operations or financial condition. That concludes the financial summary for Assurant Inc. Feel free to comment below, and I will be happy to answer them when possible.